3 charitable giving mistakes that cost $134,000. If you're over 60 and planning to give to charity, there's a costly trap you need to know about. The average retiree loses up to $134,000 over their lifetime simply by making these 3 common charitable giving mistakes. Let me repeat that. $134,000 lost, money that could have supported your favorite causes or stayed in your family's legacy. Most people think writing a check is enough, but the tax code is filled with overlooked opportunities and devastating pitfalls, especially for those with significant retirement savings. Every year you wait, the impact grows on your finances, your family, and the charities you care about. In my 3 decades of guiding affluent retirees, I've seen even the most well-intentioned donors fall victim to these errors. The most successful retirees I work with all use smarter giving strategies to maximize their impact and minimize their taxes. This is educational content designed to help you make informed financial decisions. Always consult a qualified advisor, and remember, past performance doesn't guarantee future results. Today, I'll reveal the 3 mistakes that cost retirees thousands and exactly how you can avoid them. By the end, you'll know how to give more, save more, and protect your legacy. What I'm about to share could change how you give forever. But first, let me show you the most overlooked mistake of all. Part 1. The costly blind spots in charitable giving after 60. Let's start with a reality check that's going to surprise you, maybe even frustrate you. If you're like many Americans over age 60, you've spent decades building up your retirement savings, working hard, and planning carefully for your future. Now, as you enter this next chapter, you want to give back. Maybe it's your church, a hospital that helped your family, your alma mater, or a cause that's close to your heart. But here's the problem. The way most retirees approach charitable giving is actually costing them and their families a staggering amount of money. Let me share a statistic that might stop you in your tracks. According to IRS data and recent studies by the National Philanthropic Trust, American seniors collectively lose over $2.6 billion each year in unnecessary taxes and missed opportunities, simply because of avoidable charitable giving mistakes. Let me repeat that. Over $2.6 billion every single year slipping through the cracks. If you break that down, it means the average retiree who gives to charity is losing between $15,000 and $134,000 over their retirement, money that could have supported even more good causes or gone to their children and grandchildren. Now you might be thinking, that can't possibly be me. I'm careful. I've talked to my accountant. But in my 30-plus years of helping retirees with substantial savings, people just like you, I've seen even the most financially savvy individuals make these mistakes. It's not about carelessness, it's about blind spots. The tax code around charitable giving is complex, constantly changing, and filled with nuances that trip up even seasoned investors and professionals. Here's what I see most often: retirees who want to make a difference, who have the means to be generous, but who end up writing checks from their checking account, not realizing that this simple act could trigger thousands of dollars in unnecessary taxes. Or perhaps you've heard about required minimum distributions, or RMDs, from your IRA. What many people don't realize is that the IRS actually gives you a way to satisfy your RMD and support your favorite charity at the same time, without paying a dime in taxes on that income. Yet, according to Fidelity's 2023 retirement survey, less than 18% of retirees actually use this strategy. That means 82% are missing out on what could be up to $30,000 in tax savings every year, depending on their account size and giving goals. Let me give you a real-world example based on a client I worked with recently. This couple, both in their mid-70s, had spent their lives supporting their church and local charities. Each year, they'd write a check for $10,000 from their joint checking account. They felt good about giving, but they didn't realize that those gifts were coming from after-tax dollars. Over a decade, they paid nearly $22,000 more in taxes than they needed to, all because they didn't know about qualified charitable distributions from their IRAs. That's money that could have gone to their grandchildren's education fund or supported even more charitable work. Or consider another scenario: a retiree with a substantial stock portfolio who donates cash instead of appreciated securities. By not gifting the stock directly, they missed out on a capital gains tax break that would have saved them $14,000 in a single year. These are not isolated incidents. They're happening all across the country, every single day. Why does this matter even more after age 60? For one, your income picture changes. You may be drawing from Social Security, required to take minimum distributions from your retirement accounts, or facing higher medical expenses. Every dollar counts, and every decision you make has a ripple effect on your taxes, your legacy, and your ability to give. The window for maximizing these strategies is narrow, and the stakes get higher as you age. The IRS doesn't give do-overs if you miss the deadline or use the wrong account. Once the opportunity is gone, it's gone for good. Let me repeat that important point. After age 60, the rules around charitable giving become more complex, but the opportunities to save money and give more are greater than ever. Yet most retirees are still using the same giving strategies they used in their 40s and 50s, not realizing that the tax landscape has shifted beneath their feet. The cost of these mistakes isn't just measured in dollars and cents. It's measured in missed opportunities to create the legacy you want, to support the causes you care about most, and to ensure your family's financial security. I've seen thousands of seniors make these same mistakes, often because they're relying on outdated advice or simply don't have the right information. The most successful retirees I work with always take the time to review their giving strategies every year, especially as they approach and move through their 60s and 70s. They know that the sooner you implement these changes, the more you and your favorite charities stand to gain. But here's what most financial advisors won't tell you. The biggest mistakes aren't just about missing a deduction or paying a little extra in taxes. They're about missing out on strategies that could have multiplied your impact, reduced your tax bill by tens of thousands, and protected your family's financial future. And the window to fix these mistakes is closing faster than most people realize. This is educational content, not personalized financial advice. You should always consult with a qualified financial advisor who understands your specific situation before making any changes to your giving or investment strategy. I'm here to help you understand the landscape so you can ask the right questions and make the most informed decisions possible. So far, we've covered the magnitude of the problem, the hidden costs, and why this matters so much after age 60. You've seen how easy it is to fall into these traps, even with the best intentions. Now you might be wondering, if these mistakes are so common, what's the right way to give? That's exactly what we're going to explore next. The solution is simpler than you think, but most people get it wrong. Let me show you the proven strategies that can help you give more, save more, and protect your legacy, starting with the core foundation that every retiree should know. Part 2. The core foundation: how strategic giving can multiply your impact and savings. Let's take a deep breath together and shift from the costly mistakes we just uncovered to the core solution, the foundation that can transform your charitable giving from a financial drain into a powerful, tax-smart legacy tool. I want you to know, from my 30-plus years of helping retirees just like you, that there are proven, conservative strategies that not only protect your nest egg, but also allow you to give more generously than you ever thought possible. At the heart of this approach is something I call strategic giving. It's not about writing bigger checks or taking bigger risks. Instead, it's about aligning your charitable gifts with the unique tax and financial opportunities available to you after age 60. The tax code, while complicated, actually rewards retirees who know how to use the right accounts and the right timing. And the difference, as you've seen, can be tens of thousands. sometimes over $100,000 in lifetime savings. Let me repeat that. Just by changing the way you give, not how much you give, you could potentially save or redirect between $15,000 and $134,000 over your retirement. So what exactly is strategic giving? For most affluent retirees, it comes down to three main techniques: using Qualified Charitable Distributions, QCDs, directly from your IRA, donating appreciated assets like stocks or mutual funds instead of cash, and taking full advantage of donor-advised funds for larger or more complex giving plans. Each of these methods works with your existing retirement accounts and investment portfolios, and they're specifically designed to fit the financial realities of people in their 60s and 70s. Let's talk about QCDs for a moment, because this is one of the most powerful yet underused tools for retirees. If you're over age 70 and a half, the IRS allows you to transfer up to $100,000 per year directly from your IRA to a qualified charity. This transfer counts toward your required minimum distribution, RMD. But here's the magic: it's not included in your taxable income. That means you can satisfy your RMD, support your favorite causes, and potentially lower your Medicare premiums and Social Security taxes, all in one move. In my experience, retirees who use QCDs typically save between $4,000 and $15,000 per year in taxes, depending on their RMD amount and tax bracket. Now, let me share a brief success story. I worked with a retired engineer in Texas. We'll call him John. John was giving $12,000 a year to his church, but he was taking the money from his checking account after paying taxes on his IRA withdrawals. When we switched him to QCDs, not only did he meet his RMD, but his taxable income dropped by over $10,000 that year. The result? He saved $3,200 in federal taxes and another $600 on his Medicare premiums. Over the next decade, that's nearly $40,000 in savings, money he could use for family vacations, medical expenses, or even more giving. Another strategy that works especially well for retirees with investment portfolios is gifting appreciated assets. If you've owned stocks or mutual funds for more than a year and they've increased in value, you can donate them directly to a charity. You avoid paying capital gains tax on the appreciation, and you may receive a charitable deduction for the full market value. Let me give you an example. A couple I advised in Florida had $50,000 in Apple stock they bought years ago for just $10,000. If they sold the stock, they'd owe capital gains tax on $40,000 of growth, about $6,000 in taxes. By donating the stock directly, they avoided that tax and got a deduction for the full $50,000. That's a $6,000 savings in 1 year just by changing the form of their gift. Donor-advised funds are another tool that can make a huge difference, especially if you want to bunch several years of giving into one tax year, or if you want to involve your children or grandchildren in your philanthropy. These funds allow you to make a large, tax-deductible gift now, often using appreciated assets, and then distribute the money to charities over time. It's a strategy that many wealthy retirees use to manage their tax brackets, create a family legacy, and simplify their giving all at once. What makes these strategies so effective for people in their 60s and beyond? The answer is timing and tax efficiency. After age 60, your income sources change. You might be drawing Social Security, taking RMDs, or facing higher healthcare costs. Every dollar of taxable income can affect your Medicare premiums, your tax bracket, and even how much of your Social Security is taxed. By using QCDs, appreciated securities, or donor-advised funds, you can control your taxable income, minimize the impact of RMDs, and maximize the value of your charitable gifts, all without increasing your risk or complicating your finances. I want to emphasize, these are not risky, get-rich-quick schemes. These are conservative, IRS-approved strategies with a 40-plus-year track record of helping retirees keep more of their money, support the causes they care about, and protect their family's legacy. In fact, the most successful retirees I work with review their giving strategies every single year, adjusting for tax law changes, market conditions, and family needs. Let me repeat that important point. You don't need to give more, you just need to give smarter. The sooner you implement these strategies, the more you and your favorite charities stand to gain. Every year you wait, you could be losing thousands in unnecessary taxes, money that could have funded scholarships, medical research, community programs, or your own grandchildren's future. Of course, this is educational content, not personalized financial advice. Your situation is unique, and you should always consult with a qualified financial advisor before making any changes to your giving or investment strategy. But I want you to feel empowered, informed, and ready to take action. You have the tools and the opportunity to make your charitable giving work harder for you and the causes you love. So far, we've covered the core foundation of strategic giving, the what and the why. Now, let's move to the how. In the next section, I'll show you exactly how to implement these strategies in your own life, step by step, with real numbers, timelines, and answers to the questions I hear most often from retirees. The solution is simpler than you think, but most people get it wrong. Now, let me show you exactly how to implement this. Part 3. Step by step, how to make your charitable giving work for you. Now that you understand the core foundation of strategic charitable giving, it's time to get practical. I want you to walk away from this video with clear, actionable steps you can take, starting today, to make sure your gifts are working as hard for you as they are for the causes you care about. In my 30-plus years of guiding retirees through these exact decisions, I've learned that a step-by-step approach is the most effective way to turn good intentions into real financial results. Let's break this down into 5 specific steps. I'll walk you through each one using real numbers, realistic time frames, and the kinds of questions I hear every week from thoughtful, conservative retirees. Remember, this is educational content, not personalized financial advice. Please consult with a qualified financial advisor who understands your unique situation before making any changes to your giving or investment strategy. Step 1. Review your current giving and retirement accounts within the next 30 days. The first step is to take a close look at how you're currently giving. Pull out your checkbook, your online statements, or your year-end summary from your favorite charities. Add up the total amount you gave last year, whether it was $2,500, $10,000, or even $50,000. Next, make a list of your retirement accounts, especially any IRAs. Note your current balance, your age, and whether you're already taking required minimum distributions, RMDs. If you're over 70 and a half, this is critical because you're eligible for Qualified Charitable Distributions, QCDs. For example, let's say you're 72 years old and your IRA balance is $400,000. Your RMD for the year might be around $15,000. If you're already giving $7,000 a year to charity from your checking account, you could instead direct up to $7,000 of your RMD straight to the charity as a QCD and potentially avoid paying income tax on that amount. Step 2. Set up Qualified Charitable Distributions, QCDs, within 30 to 45 days. If you're eligible for QCDs, reach out to your IRA custodian. This could be Fidelity, Schwab, Vanguard, or your local bank. Ask them for their QCD request form. Each institution has its own process, but most will let you send a check directly from your IRA to the charity of your choice. Make sure the check is made out to the charity, not to you. You can give up to $100,000 per year this way, and it counts toward your RMD. The process usually takes about 2 weeks from start to finish, but I recommend starting this no later than November each year to avoid year-end processing delays. Remember, the IRS requires that the funds go directly from your IRA to the charity. If you withdraw the money first and then write a check, you'll lose the tax benefit. Let me repeat that. The check must go straight from your IRA to the charity. If you're unsure about the paperwork, Your financial advisor or IRA provider can walk you through it. Many retirees find that once they've done this once, it's easy to repeat every year. Step 3. Identify appreciated assets for direct donation within 60 days. If you have stocks, mutual funds, or even exchange-traded funds, ETFs, that have gone up in value since you purchased them, consider donating those assets directly to charity instead of cash. This is especially powerful if you've held the asset for more than 1 year. By donating the appreciated shares, you avoid capital gains tax and may receive a deduction for the full fair market value. Here's a concrete example. Suppose you bought 200 shares of a blue-chip stock at $40 per share years ago, and today it's worth $100 per share. That's $20,000 in current value with $12,000 in unrealized gains. If you donate those shares directly, you avoid paying capital gains tax on the $12,000 gain, which could save you between $1,800 and $3,000 depending on your tax bracket. To do this, call your investment advisor or the charity's planned giving office. They'll provide transfer instructions, typically a simple form or a letter of authorization. Most transfers are completed within 7 to 10 business days, so plan accordingly if you want the gift to count for this tax year. Step 4. Consider a donor-advised fund for larger or complex gifts within 90 days. If you're planning to give more than $10,000 in a single year, or you want to bunch several years' worth of giving into one tax year to maximize your deductions, a donor-advised fund, DAF, can be a flexible, tax-efficient solution. With a DAF, you make a single, large contribution, often using appreciated assets, to the fund, receive an immediate tax deduction, and then direct grants to your favorite charities over time. For example, if you plan to give $15,000 a year for the next 5 years, you could contribute $75,000 to a DAF this year, claim the full deduction, subject to IRS limits, and recommend 15,000 annual grants to your chosen charities. This approach can be especially useful if you're having a high-income year, perhaps after selling a property or business. Setting up a DAF usually takes about 2 weeks. You can open one with major financial institutions like Fidelity Charitable, Schwab Charitable, or your local community foundation. Be sure to review the fees and minimums, which can range from $5,000 to $25,000 to open an account. Step 5. Coordinate with your tax advisor and track your giving, ongoing annually. Finally, make sure your tax advisor is aware of your charitable giving plans each year. Provide documentation of your QCDs, stock transfers, or DAF contributions. This will help ensure you get every dollar of tax benefit you're entitled to and avoid any reporting errors that could trigger IRS questions down the road. Each January, review your giving from the previous year and set your plan for the new year. The most successful retirees I work with always schedule a charitable review with their advisor every year, often in the fall, before the year-end rush. Let me recap what we've covered so far. First, you'll review your current giving and retirement accounts within the next 30 days. Next, you'll set up QCDs if you're eligible, typically within 30 to 45 days. Then you'll identify appreciated assets to donate directly within 60 days. If you have larger or more complex giving goals, you'll consider a donor-advised fund within 90 days. And throughout, you'll coordinate with your tax advisor to make sure everything is tracked and reported correctly. Now, I know you might have some concerns. What if you make a mistake on the paperwork? What if the stock market drops after you transfer your shares? What if you want to change your giving plan later in the year? These are all valid questions, and in my experience, they're the kinds of issues that can trip up even the most careful retirees. The good news is, with a little preparation and the right support, you can avoid most of these headaches and keep your giving strategy on track. I also want to address a common concern I hear from retirees. Will these strategies affect my Social Security or Medicare? The answer is they can actually help. By reducing your taxable income with QCDs, You may lower the portion of your Social Security that's subject to tax, and you might even qualify for lower Medicare premiums. Every dollar you keep in your pocket is a dollar that can support your retirement lifestyle, your family, or your favorite charities. Let me repeat that important point. These steps are designed to be conservative, low risk, and proven over decades of use by retirees across the country. You're not gambling with your savings. You're using the rules to your advantage in a way that protects your principal and maximizes your impact. As always, this is educational content, not personalized financial advice. Please consult with a qualified financial advisor for your specific situation. And remember, the sooner you start, the more you and your favorite charities stand to gain. So far, we've covered the practical steps to transform your charitable giving, reviewing your accounts, setting up QCDs, donating appreciated assets, considering a donor-advised fund, and coordinating with your tax advisor. But before you take action, you need to avoid these critical mistakes that can cost you thousands and undo all your good work. Before you do anything, avoid this costly mistake. Part 4. Avoiding the most expensive charitable giving mistakes. Now that you have a clear step-by-step plan for making your charitable giving more tax-efficient and impactful, let's pause and talk about the pitfalls, the costly mistakes that I've seen far too many retirees make. These are not minor oversights. In my 30-plus years working with retirees, I've watched these common errors cost people anywhere from a few $1,000s to well over $134,000 across their retirement. Let me repeat that. These are real dollars lost, dollars that could have stayed in your family or gone to support the causes you care about. So, what are the most expensive mistakes, and how can you avoid them? I want to walk you through 4 of the most common, along with the warning signs you should watch for. As always, this is educational content, not personalized financial advice. Please consult with a qualified financial advisor for your unique situation. Mistake number 1. Writing checks from your bank account instead of using a Qualified Charitable Distribution, or QCD. This is the single most common and costly mistake I see among retirees over age 70 and a half. Let's say you're taking required minimum distributions, RMDs, from your IRA. If you write a $10,000 check to your favorite charity from your checking account, you're using money that's already been taxed as income. But if you direct that same $10,000 from your IRA as a QCD, you avoid paying income tax on the distribution entirely. Here's the financial impact. For someone in the 22% federal tax bracket, giving $10,000 from your checking account means you could be paying $2,200 in unnecessary taxes that year. Over a decade, that's $22,000 lost just for giving in the wrong way. I've seen retirees lose even more when their RMDs are higher or when state taxes are factored in. Warning sign: if you're over 70 and a half and still writing checks to charity from your personal bank account, you're likely missing out on significant tax savings. Review your giving method each year with your advisor or IRA custodian. Mistake number 2. Donating appreciated securities incorrectly or not at all. Many retirees have investments, stocks, mutual funds, or ETFs that have grown significantly over the years. Donating these appreciated assets directly to charity is one of the most tax-efficient ways to give because you avoid capital gains tax and may receive a deduction for the full market value. But the mistake comes when people either sell the asset first, triggering capital gains tax, and then donate the cash, or simply never consider donating securities at all. Let's put numbers to this. Suppose you have $30,000 in stock that you bought for $10,000 years ago. If you sell the stock first, you'll owe capital gains tax on the $20,000 gain, about $3,000 at a 15% tax rate. If you donate the stock directly, you avoid that tax entirely. Over time, I've seen retirees pay $10,000, $20,000 or more in unnecessary taxes simply because they didn't know about this strategy. Warning sign: If you've sold investments to fund a charitable gift, or if you've never discussed donating securities with your advisor, you could be missing out on thousands in tax savings. Mistake number 3. Missing key deadlines for charitable giving. Timing is everything in charitable giving. The IRS has strict rules about when gifts must be made to count for the current tax year. For QCDs, the check must clear from your IRA before December 31st. For appreciated securities, the shares must be transferred and received by the charity before the end of the year. Every year, I see retirees rush to make gifts in late December, only to miss the deadline and lose out on all the tax benefits. Let me give you an example. A couple I worked with wanted to make a $25,000 QCD in December, but their IRA custodian didn't process the request in time. The check didn't clear until January 3rd, and they lost out on $5,500 in tax savings for that year. I've seen similar mistakes with stock transfers that get caught up in holiday backlogs. Warning sign: if you're planning a year-end gift, start the process no later than November 15th. Waiting until December puts you at serious risk of missing out. Mistake number 4. Failing to coordinate giving with your overall tax and retirement plan. Charitable giving doesn't happen in a vacuum. Every decision you make, how you give, what you give, and when you give can affect your taxable income, your Medicare premiums, and even how much of your Social Security is taxed. I've seen retirees who make a large cash gift in a single year, only to push themselves into a higher Medicare bracket, costing them an extra $2,000 or $3,000 in premiums annually for years to come. Or consider someone who takes a large RMD in December, then makes a big charitable gift in January. They miss the chance to offset their taxable income in the right year and lose thousands in potential savings. Warning sign: if your financial advisor or tax preparer isn't asking about your charitable giving each year, or if you're not reviewing your giving strategy alongside your retirement withdrawals, you could be leaving money on the table. Let me repeat these important points. Writing checks from your bank account, mishandling appreciated securities, missing IRS deadlines, and failing to coordinate your giving with your overall plan are the 4 most expensive mistakes I see. Each one can cost you thousands, sometimes tens of thousands, of dollars over your retirement. The most successful retirees I work with always review their giving strategies every year, ideally in the fall. They coordinate with their financial advisor and tax preparer, and they never wait until the last minute. They know that every month they delay could cost them money, and that the window for these tax-saving strategies is closing faster than most people realize. Remember, these are conservative, proven strategies with a 40-plus year track record. You're not taking unnecessary risks. You're simply making sure your hard-earned money goes as far as possible for you, your family, and your favorite causes. And as always, this is educational content, not personalized financial advice. Please consult with a qualified advisor for your specific situation before making any changes. So far, we've covered the most expensive mistakes and the warning signs to watch for. Once you avoid these traps, you can access advanced strategies that most people never learn. Techniques that can help you maximize your impact, protect your legacy, and potentially save even more in taxes. Once you avoid these traps, you can access advanced strategies that most people never learn. Part 5. Advanced Strategies. Unlocking even greater benefits from your charitable giving. Now that you know how to avoid the most expensive charitable giving mistakes, let's take your strategy to the next level. If you're watching this, you're already ahead of the curve. You understand the basics, you know how to sidestep the pitfalls, and you want to make the absolute most of every dollar you give. In my 30-plus years of helping affluent retirees optimize their giving, I've seen that the most successful donors don't just stop at the basics. They use sophisticated but still conservative strategies to maximize their impact and protect their wealth for the long term. Let's talk about two advanced techniques that have helped many retirees I've worked with save tens of thousands of dollars while leaving a legacy that lasts. I'll also explain the tax implications so you can see exactly how these moves affect your bottom line. As always, this is educational content, not personalized financial advice. Be sure to consult a qualified financial advisor for your specific situation. Advanced strategy number 1. Bunching charitable contributions for maximum tax deduction. After age 60, many retirees find that the new, higher standard deduction means they no longer get a tax benefit from their charitable gifts each year. In 2024, the standard deduction for a married couple filing jointly is $29,200. If your itemized deductions, including charitable giving, mortgage interest, and state taxes, don't exceed this amount, you won't see a tax benefit from your donations. Here's where bunching comes in. Instead of giving $10,000 a year for the next 3 years, you might combine, or bunch, 3 years' worth of gifts into a single year, giving $30,000 at once. That pushes your itemized deductions over the standard deduction, allowing you to claim a much larger deduction that year. In the following 2 years, you take the standard deduction and pause your charitable giving or give smaller amounts. Many retirees use a donor-advised fund, DAF, for this strategy. You contribute the full $30,000 to the DAF in year 1, take the big deduction, and then direct $10,000 grants to your favorite charities each year. This approach can save you between $2,000 and $8,000 in federal taxes, depending on your tax bracket and other deductions. I recently worked with a couple in California who used this technique. By bunching their gifts and using a DAF, they saved $6,400 in federal taxes over 3 years, money they were then able to use for a special family trip and additional giving to their church. Advanced strategy number 2. Charitable remainder trusts, turning appreciated assets into lifetime income. If you have highly appreciated assets, such as stocks, real estate, or even a business interest, and you want to support charity while also securing lifetime income, a charitable remainder trust, CRT, can be a powerful solution. Here's how it works. You transfer the appreciated asset into the trust sells it without paying immediate capital gains tax, and then pays you or your spouse a stream of income for life or a set number of years. When the trust ends, the remaining assets go to the charity of your choice. Let's look at the numbers. Suppose you have $500,000 in stock you bought for $100,000. If you sold it outright, you'd owe capital gains tax on $400,000, potentially $60,000 or more in federal taxes alone. With a CRT, the trust sells the stock tax-free, invests the full $500,000, and pays you, say, 5% per year, $25,000 annually, for life. You also get a charitable deduction up front, often between $100,000 and $150,000, depending on your age and the trust terms. When you and your spouse pass, the remainder, often hundreds of thousands of dollars, goes to your chosen charity. I've seen retirees use CRTs to fund their retirement lifestyle, support multiple charities, and create a meaningful legacy, all while avoiding a huge tax bill. The most successful retirees I work with always coordinate this strategy with their estate and tax planning team to ensure everything is set up correctly. Advanced strategy number 3, using Qualified Charitable Distributions QCDs to lower Medicare premiums and Social Security taxes. We've already talked about QCDs as a basic strategy, but here's an advanced twist. Using QCDs strategically to manage your Modified Adjusted Gross Income, MAGI, which determines both your Medicare premiums and the portion of your Social Security that's taxable. For example, if your MAGI crosses certain thresholds, $206,000 for married couples in 2024, you'll pay higher Medicare Part B and D premiums, known as IRMA surcharges. By directing a portion of your required minimum distribution to charity via a qualified charitable distribution, You can keep your modified adjusted gross income below these thresholds and avoid the surcharges. For some retirees, this can mean saving between $1,500 and $4,000 per year in Medicare premiums, in addition to the income tax savings. One retiree I advised was able to use QCDs to keep her Maggie just under the IRMA limit for 5 consecutive years, saving more than $12,000 in Medicare costs alone. That's in addition to the satisfaction of supporting her alma mater and local food bank. Key tax implications to remember. Each of these strategies has its own tax rules and reporting requirements. For bunching and DAFs, you must itemize deductions in the year you make the contribution. For CRTs, you'll need a specialized attorney to draft the trust and a tax advisor to calculate the deduction and income stream. For QCDs, the distribution must go directly from your IRA to the charity, never to you first. The IRS rules can be complex, but these strategies have a 40-plus year track record of delivering real, measurable benefits to retirees who take the time to plan ahead. The most successful retirees I work with never try to do this alone. They build a team that includes a financial advisor, a CPA, and, for trusts, an estate planning attorney. Let me repeat that important point. These are not aggressive or risky tactics. They are conservative, safety-first methods that wealthy retirees and industry insiders have used for decades to maximize their giving and minimize taxes. Every month you delay, you could be missing out on thousands of dollars in savings, or even worse, missing a window that closes with the calendar year. As always, this is educational content, not personalized financial advice. Please consult with a qualified financial advisor and tax expert for your specific needs and goals. So far, we've explored advanced charitable giving strategies, bunching gifts for bigger deductions, using charitable remainder trusts to turn assets into income and legacy, and leveraging QCDs to reduce Medicare and Social Security taxes. The key to success is getting your timing exactly right, knowing when to act, which deadlines to hit, and how to sequence each step for maximum benefit. The key to success is getting your timing exactly right. Part 6, your step-by-step timeline, when and how to act for maximum benefit. Now that you know the advanced strategies that can multiply the impact of your charitable giving, let's talk about timing and sequence. In my 30-plus years helping retirees optimize their financial lives, I've seen that even the best strategies can fall flat if the implementation isn't carefully timed. The IRS, your IRA custodian, and even the charities themselves all have their own rules and calendars. Missing a single deadline can mean losing thousands in tax savings or even undoing months of careful planning. Let me walk you through a practical, proven timeline, a 30, 60, 90-day action plan to help you put everything we've discussed into motion. I'll highlight the most important dates and decision points so you know exactly what to do first, second, and third. And remember, this is educational content, not personalized financial advice. Please consult with a qualified advisor to tailor this sequence to your unique situation. First 30 days. Assess, organize, and set your giving goals. The first step is all about clarity and preparation. Set aside some quiet time, maybe with your spouse or a trusted family member, to review your current financial picture. Pull together your most recent IRA statements, brokerage account summaries, and a list of any appreciated assets you own, stocks, mutual funds, or even real estate. Make a list of the charities you want to support this year and jot down your giving goals. Are you planning to give $5,000, $20,000, or more? Do you want to support one organization or several? During this first month, it's also critical to check your age and RMD status. If you're 70 and a half or older, you're eligible for Qualified Charitable Distributions, QCDs. If you're considering a donor-advised fund or a charitable trust, now is the time to schedule a meeting with your financial advisor and your CPA. The most successful retirees I work with always start these conversations in the fall, September or October, so they're not rushed by year-end deadlines. Day 1 to 30. Checklist. Gather IRA and brokerage statements. List your appreciated assets. Define your charitable giving goals for the year. Confirm your RMD amount and deadline. Schedule meetings with your advisor and tax professional. Next 30 days, day 31 to 60. Initiate your giving strategies and begin transfers. Now that you have your goals and paperwork in order, it's time to take action. If you're planning to use QCDs, contact your IRA custodian and request their QCD form. This process can take anywhere from a few days to 2 weeks, depending on the institution. Make sure the checks are made payable directly to the charities, not to you, and that you keep copies of all paperwork for your tax records. If you're donating appreciated securities, call your investment advisor or the charity's planned giving office. They'll provide instructions for transferring the shares. Most charities will need a letter of authorization, and the transfer itself can take up to 10 business days. To ensure the gift counts for this tax year, aim to initiate the transfer by early December at the latest. I always recommend starting in October or November just to be safe. If you're setting up a donor-advised fund, now is the time to complete the application and transfer your assets. Most DAFs require a minimum initial gift, typically between $5,000 and $25,000, and the paperwork can take a week or 2 to process. Once your DAF is funded, you can recommend grants to your favorite charities right away or spread them out over time. For those considering a charitable remainder trust or more complex strategies, this is the window to meet with your estate planning attorney. Drafting and funding a trust can take 30 to 60 days, and you'll want to leave plenty of time for legal review and asset transfers before year-end. Day 31 to 60. Checklist. Submit QCD paperwork to your IRA custodian. Initiate stock or mutual fund transfers to charities. Complete donor-advised fund applications and initial funding. Meet with your estate attorney for trust setup, if applicable. Keep detailed records of all communications and transactions. Final 30 days, day 61 to 90. Confirm, document, and review. With your gifts in motion, the final phase is all about verification and documentation. Contact each charity to confirm they received your donation and that it was processed as a direct transfer for QCDs or appreciated assets. Ask for a written acknowledgement or receipt. This is essential for your tax return. If you've used a donor-advised fund, log into your account and review the grant history to ensure your recommendations were executed correctly. For QCDs, make sure the amount is properly reported on your year-end IRA statement. For appreciated securities, check that the transfer was completed before December 31st. Now is also the time to meet with your CPA or tax preparer. Provide them with all donation receipts, QCD confirmation letters, and any documentation related to trusts or DAFs. Discuss how your giving may affect your taxable income, Medicare premiums, and Social Security taxation for the coming year. The most successful retirees I work with always review their giving results in January so they can adjust their strategy for the next year. Day 61 to 90, checklist. Confirm receipt of all gifts with each charity. Collect written acknowledgments for tax purposes. Verify QCD and appreciated asset transactions on account statements. Review your DAF grants and balances. Meet with your CPA to finalize tax reporting. Important deadlines and dates to remember. December 31st. All QCDs and appreciated asset transfers must be completed and received by the charity to count for the current tax year. Don't wait until the last week of December. Processing delays are common. October-November. Ideal window to initiate all giving strategies, especially for complex gifts or new accounts. January 15th. Review your previous year's gifts and set your goals for the new year with your advisor. Let me repeat that important point. Timing is everything. The IRS doesn't offer do-overs if you miss a year-end deadline. Every month you delay can mean lost tax savings, higher Medicare premiums, or missed opportunities to create the legacy you want. The most successful retirees I've worked with treat charitable giving as an annual scheduled process, never a last-minute scramble. As always, this is educational content, not personalized financial advice. Please consult with a qualified financial advisor to ensure these steps fit your personal situation and goals. So far, we've mapped out a clear step-by-step timeline. Assess and organize in the first 30 days, initiate your giving strategies in the next 30, and confirm and document in the final 30. Even if you follow this perfectly, you might encounter common roadblocks, unexpected delays, paperwork errors, or last-minute questions from your advisor or the charity. Don't worry, you're not alone. Even if you follow this perfectly, you might encounter these common roadblocks. Part 7. Troubleshooting and Problem Solving. Overcoming the roadblocks to smart charitable giving. You've done the hard work of planning your charitable giving, you know the advanced strategies, and you've mapped out a timeline to maximize your benefits. But in my 30-plus years guiding retirees through this process, I can tell you even the most prepared donors run into unexpected roadblocks along the way. The good news is, with a little foresight and the right guidance, you can overcome these challenges and keep your giving plan on track. Let's talk through the most common issues I've seen, along with practical solutions and what-if scenarios that can help you avoid frustration, lost tax benefits, or costly mistakes. Remember, this is educational content, not personalized financial advice. Always consult a qualified financial advisor for your unique situation. Challenge number 1, delays in processing QCDs or appreciated asset transfers. One of the most frequent challenges retirees face is delays in getting their Qualified Charitable Distributions, QCDs, or stock donations processed by their IRA custodian or brokerage firm. Especially as the year winds down, financial institutions get swamped with last-minute requests. If your QCD check isn't issued or your stock transfer isn't completed by December 31st, the IRS won't let you count the gift for that tax year. Let me share a real scenario. A client of mine, we'll call her Linda, requested a $20,000 QCD from her IRA on December 15th. The custodian mailed the check to the charity, but due to holiday mail delays, it wasn't deposited until January 3rd. Linda missed out on $4,400 in tax savings for that year. Solution: always start the process early. I recommend initiating all QCDs and appreciated asset transfers by mid-November at the latest. After submitting your paperwork, follow up with both your financial institution and the charity to confirm receipt. Request tracking numbers for checks and written acknowledgement from the charity as soon as the gift arrives. If you're getting close to the year-end deadline and haven't received confirmation, call your advisor immediately. They may be able to expedite the process or suggest an alternative. What if you miss the deadline? If your QCD or stock donation isn't completed by December 31st, unfortunately, it will count for the next tax year. While you can't retroactively claim the tax benefits, you can adjust your plan for the upcoming year and set reminders to start earlier. Challenge number 2, incorrect paperwork or reporting errors. Another common stumbling block is paperwork. Either the wrong forms are used, information is missing, or the transaction is incorrectly reported to the IRS. For example, if your IRA custodian makes the QCD check payable to you instead of the charity, the IRS will treat it as a taxable distribution. Or if you donate appreciated securities but the charity doesn't provide the right acknowledgement, your tax deduction could be denied. I've seen retirees lose out on thousands in tax savings simply because a box was checked incorrectly or documentation was incomplete. Solution: double-check every form before you submit it. For QCDs, ensure the check is made payable directly to the charity and that you never take possession of the funds. For appreciated securities, confirm with the charity's finance office exactly how to transfer the shares. They'll usually provide a letter of authorization or transfer instructions. After the transaction, request a written acknowledgement that clearly states the amount and date of the gift and whether any goods or services were received in exchange. What if there's an error on your 1099-R or other tax forms? If your IRA custodian reports your QCD as a regular distribution, don't panic. You can still claim the QCD on your tax return by attaching an explanation and keeping all supporting documents. Your tax advisor can guide you through the process and ensure you don't pay unnecessary taxes. Challenge number 3. Charities unable or unwilling to accept certain gifts. Not all charities are equipped to handle complex gifts like appreciated securities, real estate, or donor-advised fund grants. Some smaller organizations may only accept cash or checks, or they may not have the brokerage account required to receive stock transfers. One retiree I worked with wanted to donate $50,000 in mutual funds to a local animal shelter, only to discover they couldn't accept anything but cash. She was disappointed and worried she'd missed the tax deadline. Solution: before you initiate any transfer, always contact the charity's development or finance office to confirm they can accept your gift type. Larger organizations, universities, hospitals, national nonprofits almost always have systems in place for non-cash gifts. For smaller charities, consider using a donor-advised fund as an intermediary. You can donate your appreciated assets to the DEF, take the deduction, and then recommend a grant to the charity in cash. What if your chosen charity can't accept your gift? Don't give up. Either select a different charity for your non-cash gift or use your donor-advised fund to convert the asset to cash and then make the grant. Your advisor can help you coordinate the logistics so you don't lose out on your tax benefits. Challenge number 4. Unanticipated impact on Medicare premiums or Social Security taxes. Sometimes, even when everything goes right with your charitable giving, you may find your taxable income higher than expected, pushing you into a higher Medicare bracket or increasing the portion of your Social Security that's taxable. This often happens when retirees make large, one-time distributions or don't coordinate their giving with their overall withdrawal strategy. For example, I worked with a couple who made a $40,000 charitable gift from their IRA. But because they didn't use a QCD, it pushed their Modified Adjusted Gross Income, MEG, above the IRMA threshold. Their Medicare premiums jumped by $1,800 the following year, completely negating the tax benefit of their gift. Solution: always review your projected income with your tax advisor before making large gifts. Use QCDs to keep your MAGI lower, and if you're bunching gifts, consider the timing of other income sources, like Roth conversions or capital gains. The most successful retirees I work with have their advisors run what-if scenarios before making big moves, so there are no surprises come tax time. What if you've already triggered a higher Medicare premium? While you can't undo the impact for the current year, you can adjust your strategy going forward. Some retirees file an appeal with Social Security if the increase was due to a one-time event, like the sale of a property. Your advisor can help determine if you qualify for relief. Let me recap what we've covered so far. We've addressed delays in processing gifts, paperwork and reporting errors, challenges with charities accepting certain assets, and the sometimes unexpected impact on Medicare and Social Security. Each of these issues can be solved or even prevented with careful planning, clear communication, and the support of a knowledgeable advisory team. As always, this is educational content, not personalized financial advice. Please consult with a qualified financial advisor for your specific situation. Remember, the most successful retirees I've worked with never try to troubleshoot these issues alone. They reach out early, ask questions, and keep detailed records of every transaction. Once you master this foundation, knowing not just what to do, but how to overcome the roadblocks, you're ready for the next level. That's where the real power of strategic giving comes into play. Maximizing your results, scaling your impact, and making adjustments as your life and legacy goals evolve. Once you master this foundation, you're ready for the next level. Part 8. Next Level Actions and Optimization. Maximizing results and building a lasting charitable legacy. You've now built a strong foundation for tax-smart charitable giving, learned how to troubleshoot the common roadblocks, and seen how to coordinate your gifts with your broader retirement and tax strategy. But if you're like many of the successful retirees I've worked with over my 30-plus years in this field, you know that real financial security and real impact comes from thinking beyond just this year. The most accomplished donors don't just optimize for a single tax season. They scale their giving, adapt as their lives change, and create plans that can last for generations. Let's talk about the next level, how to truly maximize your results, scale your strategies, and ensure your giving continues to make a difference for years or even decades to come. Remember, this is educational content, not personalized financial advice. Please consult a qualified financial advisor and estate planning attorney for your specific needs. Advanced Optimization. Number 1. Integrate charitable giving into your estate plan. One of the most powerful ways to amplify your impact is to weave charitable giving directly into your estate plan. This isn't just about writing a bequest in your will, though that's a good start. The most effective retirees use beneficiary designations, charitable trusts, and even life insurance to ensure their giving continues after they're gone, while also minimizing estate and income taxes for their heirs. For example, naming a charity as a beneficiary of your traditional IRA is one of the most tax-efficient legacy moves you can make. Because charities pay no income tax, every dollar from your IRA goes directly to the cause, rather than being reduced by taxes if left to family. I've seen retirees redirect $100,000 or more to charity this way, while leaving Roth IRAs or taxable accounts, assets with more favorable tax treatment, to their loved ones. If you have larger charitable ambitions, a charitable remainder trust, CRT, or charitable lead trust, CLT, can allow you to provide income to your family for a set number of years, then transfer the remainder to charity. These advanced tools can reduce estate taxes, provide income for heirs, and support your favorite causes long after you're gone. Advanced Optimization Number 2, Scaling your giving with family involvement and donor-advised funds. Many retirees want to pass on not just their wealth, but their values. Involving your children or grandchildren in your charitable giving is a way to teach financial stewardship, encourage generosity, and keep your legacy alive. Donor-advised funds, DAFs, are a flexible tool for this purpose. You can open a DAF in your name, make tax-deductible contributions, and then name successor advisors, usually your children or other heirs, to continue making grants to charities after your lifetime. I've worked with families who use annual giving meetings to discuss which causes to support, review the DAF's performance, and even involve the youngest family members in choosing grants. Over 10 or 20 years, this approach can turn a $100,000 fund into a multi-generational legacy, supporting dozens of charities and teaching important lessons about philanthropy and financial responsibility. Advanced Optimization Number 3, Adjusting your strategy for changing circumstances. The tax code, your health, your family needs, and even your charitable interests will evolve as you age. The most successful retirees I know revisit their giving strategy every single year. They review their RMDs, Social Security, Medicare premiums, and tax brackets, and they adjust their giving accordingly. This might mean increasing QCDs one year to avoid a higher Medicare bracket, bunching gifts into a donor-advised fund in a year when they sell a property, or updating estate plan documents as family circumstances change. Let's look at a scenario. Suppose you receive an unexpected inheritance, or you decide to downsize your home and have a large capital gain. This could be the perfect year to make a larger charitable gift, bunching several years' worth of donations into one, or funding a new donor-advised fund. Or, if you or your spouse's health declines, you may want to accelerate your giving or put more formal structures, like a CRT or a private foundation, in place to ensure your wishes are honored. Long-term considerations. Protecting your legacy from scams and mistakes. As your charitable profile grows, so does your visibility. Unfortunately, this can make you a target for scams or high-pressure solicitations. The most successful retirees I work with always vet new charities through trusted sources like Charity Navigator or GuideStar, and they never share personal or financial information over the phone or email unless they initiated the contact. They also keep their advisors in the loop about any new giving plans, especially if they involve large or unusual gifts. Remember, your giving strategy should always be coordinated with your broader estate, tax, and retirement plans. If you're using advanced tools like charitable trusts, private foundations, or complex asset donations, make sure your advisors are communicating with each other. This integrated approach ensures you don't miss any opportunities or fall into avoidable traps. Let me repeat that important point. The wealthiest and most impactful retirees I've worked with never treat charitable giving as a set-it-and-forget-it activity. They review, adjust, and optimize every year. They involve their families, use the full range of available tools, and keep their eyes open for both opportunities and risks. And above all, they make sure their giving reflects their values and the legacy they want to leave. As always, this is educational content, not personalized financial advice. Please consult with a qualified financial advisor and estate planning attorney to ensure your giving strategy is fully optimized for your unique goals and circumstances. So far, we've explored how to integrate charitable giving into your estate plan, scale your impact with family involvement, and adjust your strategy as life changes. We've talked about protecting your legacy from scams and ensuring your advisors are working together. You're now equipped with the next-level tools to make your giving as impactful and enduring as possible. That's just the beginning, because when you combine smart charitable giving with overall retirement planning, you unlock even greater security and peace of mind for yourself and your loved ones. In our final conclusion, I'll show you how to tie all these strategies together so you can move forward with confidence. Over the past hour, we've covered a tremendous amount of ground together. You've invested your valuable time not just in learning about charitable giving, but in understanding how to turn your generosity into a powerful tax-smart legacy. We've explored the 3 charitable giving mistakes that cost retirees up to $134,000. And more importantly, we've focused on the proven strategies that can help you avoid these costly errors and maximize the impact of every dollar you give. Let's briefly recap the 8 key insights we've covered. The hidden cost of giving from after-tax accounts, why writing checks from your bank account can trigger unnecessary taxes, the power of qualified charitable distributions, QCDs, and how they let you satisfy your required minimum distributions, RMDs, tax-free. How donating appreciated securities can eliminate capital gains taxes and boost both your tax deduction and your impact. The importance of timing and deadlines and how missing them can cost you thousands. The role of donor-advised funds, DAFs, for bunching gifts and involving your family in long-term giving. Advanced charitable trusts and estate integration to provide income and legacy benefits for generations. The need to coordinate giving with your overall tax and retirement plan to avoid surprises with Medicare premiums and Social Security taxation. the critical importance of annual reviews and professional guidance so your strategy keeps working as your life and the laws change. This isn't just entertainment, it's valuable financial education. The knowledge you've gained could save you thousands, if not tens of thousands, over your retirement. In my decades of helping retirees optimize their finances, I've seen these strategies work for thousands of individuals and families across every kind of market and economic climate. This represents decades of experience distilled into practical guidance that you can use right away. Now that you understand each piece, here's how they work together. By integrating QCDs, appreciated asset donations, and donor-advised funds into your annual giving, you create a comprehensive charitable strategy that does more than just minimize taxes. It allows you to satisfy your RMDs, reduce your taxable income, avoid capital gains, and potentially lower your Medicare premiums and Social Security taxes, all while supporting the organizations and causes you care about most. The compound effect of using these strategies together is remarkable. For example, a retiree who shifts $10,000 a year in giving from after-tax cash to QCDs and appreciated securities could see $3,000 to $5,000 in annual tax savings. Over a 20-year retirement, that's $60,000 to $100,000. Money that can stay in your family, fund more giving, or provide peace of mind in uncertain times. This is why wealthy retirees often outperform those with even larger starting assets. They use every tool available, and they review their plans every year. Let me emphasize this important point. What separates financially secure retirees from those who struggle is usually knowledge and implementation, not luck or risk-taking. The most successful clients I've worked with consistently apply these principles year after year, adjusting as tax laws and family needs evolve. After helping retirees navigate multiple market cycles, I can tell you, conservative, strategic giving is one of the most powerful ways to protect your retirement and your legacy. So, what can you do right now to put this knowledge into action? Here's a clear 4-phase plan you can follow over the next 30 days to begin optimizing your charitable giving. Step 1. Assessment phase, first week. Start by gathering these 3 essential documents: your most recent IRA statement, your brokerage account summary, and a list of your charitable donations from last year. Calculate your current position, how much you gave, from which accounts, and whether you're already taking RMDs. Identify your biggest opportunity area. Are you missing out on QCDs, not donating appreciated assets, or simply not coordinating your gifts with your tax plan? Step 2. Planning phase, second week. Create your personalized timeline based on your age, RMD status, and giving goals. Research the specific options we discussed, QCDs, appreciated securities, DAFs, and see which apply to your situation. Document your current giving strategy and compare it to what you've learned today. Write down at least one change you could make this year to improve your results. Step 3. Professional consultation, third week. Schedule a meeting with a qualified financial advisor who has experience with charitable planning for retirees. Bring these specific questions. Am I maximizing my QCDs? Should I be donating appreciated assets instead of cash? Would a donor-advised fund or charitable trust make sense for my goals? How will my giving affect my Medicare premiums and Social Security taxes? Verify that your advisor understands these advanced strategies and can help you implement them correctly. Step 4. Implementation begins, fourth week. Start with the lowest risk, highest impact change. Often, this means shifting your next charitable gift from cash to a QCD or appreciated asset. Set up any new accounts, such as a DAF, if needed. Begin tracking your progress with these simple metrics: total tax savings, impact on RMDs, and the amount of giving you're able to achieve. Review your plan with your advisor and set a reminder for an annual charitable review each fall. Remember, every financial strategy carries some level of risk, and tax laws can and do change. The goal isn't perfection, it's optimization based on your unique situation. Most successful retirees implement these changes gradually over 6 to 12 months, refining their approach as they go. Don't let perfectionism prevent you from starting with small improvements. These aren't get-rich-quick schemes, they're proven, long-term strategies for building security, supporting your values, and protecting your family. Let me emphasize, this has been educational content designed to inform your decision-making. Every individual's financial situation is unique. What works for one person may not be optimal for another. Always consult with qualified financial and tax professionals before making significant changes. Past performance of any strategy doesn't guarantee future results, and tax implications may change based on future legislation. While this information provides a strong foundation, professional guidance is invaluable. A qualified financial advisor can help you customize these strategies for your specific situation. Tax professionals can ensure you're maximizing benefits while staying compliant. Estate planning attorneys can help with the legal aspects we discussed. You're now part of a community of informed retirees who refuse to settle for average results. The journey to financial optimization is ongoing. Markets change, laws evolve, and your needs will shift over time. Continue your education by staying informed about retirement planning developments and new strategies for charitable giving. Share your success stories and learn from others who are implementing these approaches. Together, we can raise the bar for what retirement giving can achieve. If this video helped clarify your retirement giving strategy, please give it a thumbs up. It helps more retirees discover these valuable insights. Share your biggest takeaway in the comments. Which strategy will you implement first? Have you already used QCDs, donated appreciated assets, or set up a DAF? What surprised you most about the strategies we covered? Subscribe for more in-depth retirement planning guidance that could save you thousands and help you build a lasting legacy. Most importantly, take action on what you've learned. Your future self, your family, and your favorite causes will thank you. Imagine the peace of mind that comes from knowing you've optimized every aspect of your charitable giving. Sleep better tonight, knowing you have a clear plan for your financial future and your legacy. Your children and grandchildren will benefit from the wise decisions you make today, and your generosity will ripple through generations. Maintain your independence and dignity by taking control of your financial destiny, because you've worked too hard to accept anything less. The sooner you implement these strategies, the more time they have to work in your favor. Every month you delay is a month of potential optimization lost. The cost of inaction often exceeds the cost of making imperfect but informed decisions. You now have knowledge that many retirees never acquire. Use it to your advantage. You'll know you're on the right track when your financial stress decreases, your confidence grows, and you have clear answers to the questions that used to keep you awake. The goal is progress, not perfection. Small improvements compound over time. Thank you for joining me on this journey to smarter, more impactful charitable giving. Your commitment to learning and taking action is what sets you apart. Remember, the wealthiest retirees I advise didn't get there by accident. They follow proven systems, review their plans every year, and never stop learning. Take the next step today and start building the charitable legacy you and your family deserve.